Hello and welcome to Money, Money, Money. I'm Sumaira Abidi. Post-Diwali is a time for new beginnings, right? So let's use this opportunity to learn some practical rules of investing which will hold you in good stead no matter where you are in your investment journey. Joining me in this endeavor is Mohit Gang, CEO and co-founder of Moneyfront. Hi Mohit, thanks very much for joining in. This is an interesting topic, right? Practical rules of investing. So first I want to ask you about the rules which to most of us, the laymen, are known just by numbers, right? So there's a rule of 72, there's a rule of 114, there's a rule of 144. What is the kind of application, what do they mean? And what is the kind of application they have in our lives?
Sure. Hi, Sumaira. Good afternoon, and it's always a pleasure to be on your show. So look, I think personal finance is one topic which can be molded in any fashion. You can make it as complex and as calculative as you want it to be, and you can make it fairly simple. It can be done on the tip of your fingers, right? So there are some basic hacks in personal finance, and I've always been a firm believer that your final objective has to be accumulation of wealth and fulfillment of your financial goals, right? So you don't have to really fight the crocodiles. You have to just cross the swamp. And to do that, you need to just know and remember a few basic mathematical hacks, which will help you be quite quick and on the toes when you deal with any personal financial equation, or when you are dealing with your advisors or your distributors. Just to tackle the first one, which you pointed out, that there is a rule of 72, a rule of 114, a rule of 144. Now, these are very simple ones. Rule of 72 is nothing, but it tells you when your money will double, right? And that's one of the basic criteria whenever any investor, in my personal experience handling clients' money, I realized the first thing a client will always try and ask you is, how much will this yield? When do you think my money can double from here on, right? And these are very complex answers. No one can give you an accurate number to it, right? But you still have certain basic formulas to determine how can this be achieved. Now, the basic formula says that whatever is the rate of return which you assume on an investment. So let's say you assume a 12% return on your investment. The rule of 72 says that divide 72 by that rate of interest, and you will get the years in which your money will double. So 72 divided by 12, which means in 6 years, your money is likely to double. Vice versa, if you apply, which means that if you let's say are investing in a KVP, which is a small savings deposit, and you know that the government tells you that your money will double in so and so years, or whatever, 12 years and so many months. So you divide 72 by 12 years, and you know the rate of return out there is 6%, right? So both ways it is applicable. This just gives you a quick way of computing when your money can actually double. It also gives you a quick check on your advisor and distributor who's committing a certain number to you, right? And you can quickly catch an unreasonable number. If there is an advisor who comes and tells you that your money will double in this investment in 3 years or 2 years, whatever, and you can quickly question, in 2 years, you mean to say 36% return? Is that even possible, right? So that's a quick hack. 114 rule is a rule which says when your money will triple, and 144 is the rule which says when your money will quadruple. Same application as the rule of 72. You divide the rate of interest, you divide 114 by the rate of interest. So let's say if the rate of interest is 10%, you divide 114 by that, your money triples in 11.4 years. You divide 144 by 10%, your money quadruples in 14.4 years, right? So it's a very simple way, and it can be used in the alternative fashion to compute the number of years, also to compute the rate of interest as well.
Okay, fair enough. These are three rules which we can keep in mind. What is the rule which can sort of include the impact of inflation?
Okay, so this is almost akin to the 72 rule. However, you're going the reverse way in this, and you follow the rule of 70 for computing. Now, most of us actually mathematically struggle to figure out what inflation is actually doing to our money. How is it impacting us mathematically? We all understand and know inflation is high. We will all talk about it in circles. We'll say, oh, inflation is 7%, this much is the reading. But we actually don't realistically know how has it impacted our money, right? And a very simple thumb rule of that is, you divide the rate of you divide 70 by the rate of inflation. The number which you arrive at tells you in how many years will your money actually halve in real worth or in real sense. Let's say the rate of inflation is 7%. You divide 70 by 7, you get a 10-year number, which means if you're holding a lakh rupees today, in 10 years time, that lakh rupee will only be worth 50,000. right? So, and if you really want to understand the impact of it, just try and assume someone who in year 2000 or in year 2001, 2002, roughly kept a lakh of rupees in the house and forgot about it, right? That 1 lakh rupee is today worth only 25,000. It's gone to two cycles of being half. If you divide by 70 and again divide by, you divide the rate of inflation, assume it at 7% and divide 70 by 8 for two times, you get to that number. So your 1 lakh is worth only 25,000 rupees today. In 20 years is depleted that much, right? So that actually gives you a real mathematical sense as to how inflation is impacting you.
Okay, what about retirement? I've often heard people refer to the Trinity rule, right? Is that a rule which is still valid today, and how does it work?
Look, Sumaira, none of these rules, to be very honest, are valid in the strictest sense of personal finance. You will actually have to go through a detailed exercise, take all assumptions into account. But for someone who just wants to do a quick calculation, top of the mind things. So let's say if I'm at age 60 and I'm about to retire with a certain corpus and I'm really worried, I will hire a personal finance expert and I'll go through a detailed exercise of my expenses and monthly expenses and then income and then figuring out will I be able to sustain for next 25, 30 years. But if I really want to do a quick income computation in my mind, I'll just apply the 4% rule, which is also called the Trinity rule. Suppose I have a corpus of 1 crore. 4% rule says 1 crore, 4% of 1 crore is 4 lakhs, which means I can withdraw up to 4% of my accumulated corpus every year for next 25 to 27 years of my retirement without impacting my corpus, right? So this withdrawal, if you think 4 lakhs a year is good enough, then 1 crore corpus is great. But if you think 4 lakhs a year is not great, then obviously you are short on your corpus and you need to really work on your corpus, or you need to work on your withdrawal rate. You need to withdraw lesser amount. Out here, there are many assumptions, Sumaira, and you rightly said that this might not be applied in the strictest sense of the rules today. The first assumption is that your retirement corpus is invested in a mix of 50 equity, 50 debt. And the underlying theorem out here is that when you invest at that kind of a ratio, it is assumed that your returns will be equivalent to the rate of inflation in the economy, right? So practically speaking, the rule says that your investment corpus has to fetch you that much return, which is able to tackle the inflation. And then the 4% rule applies quite neatly to the entire corpus. The other way of looking at it is that whatever is the annual expense which you need. So let's say if you need 5 lakh rupees a year, you multiply that by 25 basically. So 1.25 crores is the corpus of retirement which you will need to sustain yourself for next 25 to 27 years thereabouts, right? So there are many variables which can impact this equation, but at a very, very top level broad view, this gives you a clear idea of whether the retirement corpus is suitable and sustainable.
Okay, and of course, one of the more popular ones is how to, divide between equity and debt, right? Which is the 100 minus age rule. Is that exactly how it works?
It does actually, Sumaira. Look, to be very honest, it sounds too simple to be true. But for beginners, someone who's starting his career, a person in his 20s, 22, 23 years, youngsters who wanting to start their career, how much should we keep in equity? Should we put entire money into equities? Look, the right answer could be yes, you can keep and you can go and take maximum amount of risk because there are no liabilities. But a good thumb rule or a practical way is that if you are 25 years of age, put 75 into equity and 25 into debt, which means 100 minus your age is the component of equity in your portfolio. And that equity component will keep reducing as your age grows, basically. So when you touch age 50, it will be 50 equity, 50 debt. As you approach retirement, which is 60, it will become lesser equity, then it's only 40 equity and more debt. As you reach 80, it is only 20 equity and 80% is debt, which automatically takes care of portfolio rebalancing. If you actually follow it to the T, trust me, it's a very good way of doing asset allocation without getting into too many nitty-gritties and all. However, this doesn't assume that one has any liabilities, any personal finance goals, any other objectives, any loans to be paid. So all those will have to be accounted for. But at a top level, again, this works very fine.
Okay, we're going to take a very quick break now. Mohit's going to stay on with us on the other side. There are 4 more rules that we want to talk about. So stay tuned. We'll be right back. Hi, welcome back to Money, Money, Money. Mohit Gang of Moneyfront is with us, and we're talking about some practical rules of investing. So we've already discussed 4 rules. The next one also sounds, well, Mohit, the thing with these rules is that there are just too many numbers, right? So the next one is also 10, 5, 3. What does this indicate to someone like us?
Sure. I think it's just coined in terms of numbers to make it simpler and quick to understand, basically, because the number itself tells you the whole story. This again, I think, has emanated over a period of time because of a lot of false commitments being given in the market. If you meet and I don't blame anybody out here, but you will find quite a number of people giving unreasonable hope to investors on the returns which they can make out of their investments. I've seen many a cases where equity returns have been promised upwards of 15%, 18%, 20%, so on and so forth, showing some past returns which are 1 or 2 years recent returns, right? And I think for investors, it's absolutely critical that whenever they're investing for a very long term, which is like 10 years, 15 years, to assume very, very realistic numbers. In fact, it's better to err on the side of caution on this one. And that's where the 10-5-3 rule comes in, which says that from equities over a very long horizon, assume 10% returns, from debt, assume 5% return, and from cash, assume 3% return. Now, you can argue and say that equities could be 12, debt could be 6, and cash could be 4. But again, I would say it's better to err on the side of caution, because in next 20 years, I think India will turn out to be a matured economy and all the numbers will taper down more realistically. And for a very long-term financial planning exercise, it's better to go with a 10-5-3. You will never get disappointed in the long run, right? And it also kinds of checks you, gives you a good check when someone is committing you a very unreasonable number, which could be on equities. It's more often than not where people tend to commit greater numbers. So you can always keep that thing in mind and keep this rule by your side to be very realistic.
Okay. Mohit, the other thing is that, these last 2 years of the pandemic have really brought to fore the fact that not a lot of people didn't have, emergency corpus with them, or if it was available, maybe it was not sufficient. So, what is the right amount? Is there a rule for this?
Oh, absolutely. I think personal finance begins with building the emergency corpus first, and then rest everything else falls in place. I think that fundamental rule doesn't go away any point in time. The basic rule says 3x of your monthly salary is what you should keep aside, absolutely liquid. When we say absolutely liquid, it means it has to be a sweepable FD or a cash balance in your account. Even liquid funds, to that matter, in my personal opinion, I think is not great when you need an emergency corpus. Now, there are 2 tweaks to it. If you're building an emergency corpus, which is 6x of your monthly salary, then obviously you can have some portion in liquid funds and the rest in sweepable FDs, because that's immediately withdrawable. However, the minimum criteria out here is that you have to keep 3 times your monthly salary aside, which can be withdrawn overnight under any exigency in any emergency scenario. And that's absolutely must for everyone.
The other thing, Mohit, that I want to highlight is that naturally the new India has a lot of aspirations, right? But what we notice as a result of that is that people might be overextending themselves in terms of the amount of loans that they're taking. So, what is the optimum amount of EMIs that somebody should be having with them?
Oh, Sumaira, I think buy now, pay later economy is something which is to my personal opinion, doing more harm than good. It is creating a credit culture in India, which was much required. But to buy even the consumer durables, your mobile phones, every second thing on EMI, your credit card companies today give any large expense they see, they will give you an option to convert it into EMIs, right? Obviously, and you tend to buy the larger expenses like your cars and your houses on EMIs itself. The personal finance rule is very clear about it. Not more than 40% of your monthly cash salary should go into EMIs. because any amount higher than that will create problems in your overall budgets, will create problems in your savings culture. Basically, the more you part aside as EMI, the lesser you will be able to save aside for yourself and will hamper your long-term wealth creation. So the rule is 40% of your monthly expense, not more than that, goes out as EMI. This rule, Sumaira, incidentally, is also followed by many NBFCs and bank as the first criteria to assess the credit worthiness of a borrower. If a borrower is more leveraged and his monthly outgo is more than 40%, 60% in those cases, they will reject the loan application itself. So 40% is a very, very good threshold beyond which there has to be a red alert.
Okay, but Mohit, the question that everybody is asking is that there are so many rules around, where to invest, how much to invest, at what age, how much to invest. But personal finance also includes the aspect of being able to spend, right? So how much am I allowed to spend?
Oh, look, finally, it's your money. You can spend the way you would want to. But if you really want to create a good, healthy retirement corpus and are in that endeavor of creating long-term wealth, sustainable wealth for yourself, basically, the rule is 50-30-20, which means that not more than 50% of your income when you start your career has to go into routine expenses or household expenses like your groceries and your rents and other things. 30% into your lifestyle or your discretionary expenses, which could be your mobile purchases, your travel, your restaurant bills, your movie bills, and so on and so forth. And at least, I again emphasize the word at least, minimum 20% into your savings or investments. But the rule also goes ahead and says that you have to keep tweaking this formula more in favor of investments as your age grows by, which means when you reach age 40 and beyond, the ratio has to flip aside. That means at that point in time, you have to invest at least 50%. Discretionary expenses could continue to be at 30 and your regular expenses has to come down to 20%. This is assuming that your overall income has increased many folds over that tenor of your working life and you are able to the absolute amount of basic expenses remain almost similar or identical, right? So you have to keep tweaking it in favor of your investments. The more quickly you do that, the higher the proportion of savings and investments in this entire equation, the better your retirement will be and the better your wealth creation journey will.
Okay. And by the way, I must reiterate that, the rules that Mohit has spoken about, they are generic in nature and, they cannot be applied as is. He's already mentioned that some amount of discretion must be used when you're applying these rules. And, perhaps it's a good idea to also touch base with a personal finance expert. But Mohit, just for somebody who's watching this and, we've given them, almost 12 rules in total, how do these rules sort of work in conjunction with each other, or do you choose the rules to apply? I mean, how do you know what works for you?
No, actually, look, these are all very, very practical applications. I think in terms of EMI, yes, look, when you start earning your salary, what is the first thing which will you decide? You will decide how much should I invest. There, the 50-30-20 rule comes straight up into application. The second thing which you will decide is, do I need an emergency corpus and how much should that ideally be? So the emergency corpus rule of 3x comes into play. Then as you move ahead a year, 2 years down the line, you would want to leverage yourself, buy your house, buy your car, or whatever little expenses, a little higher expense. And then the rule of EMI will kick into it, right? And once you are into that cycle where you are paying EMIs, you are saving, investing, and that's when you will start bothering as your investment keeps growing. You will start wondering whether my asset allocation is right. Do I need something in debt? How much should be in equity? What are the right assets to have? And that's where your asset allocation, equity debt rule will come into play, right? And then as you really cross that minimum threshold of investments, you grow in age, your investments grow, you will start wondering, when am I doubling my wealth? When am I tripling my wealth? And how will my retirement look like? Will we have sufficient corpus at that point in time? So at that point in time, you will have to start putting those small mathematical numbers and think that when am I actually moving a square in my life, which is doubling or tripling or whatever? And will I have sufficient retirement corpus for myself, which is the basic equation which everyone wants to solve for. So my sense is all of these, Sumaira, at some point in time will come into play in one's life. Whether they come at one go or they come at different stages is a different object, is a different thing altogether. But all these rules will definitely come handy in your personal finance journey.
I know, Mohit, you said to start with the rules on, allocation first between expenses and investment. But I think most people want to start with this rule of 72, 114, 144. So I hope you have heard, Mohit, that rule comes last. Please use it practically and, not as is. Personal finance is very, very easy provided we follow the steps. Mohit, thank you very much for joining in and for talking about the practical rules of investing. With that, it's a wrap on this special edition of Money, 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 and it's time for me to say goodbye. Thank you for watching.